the institutional signal no one saw coming. Let's talk about something almost no one in retail is paying attention to right now, but that institutional insiders are quietly circling like sharks. BlackRock. Yes, the BlackRock $10 trillion in AUM, world's largest asset manager. The financial shadow behind everything from iShares ETFs to government bond auctions. And while everyone's eyes are locked on Bitcoin ETFs and Ethereum staking products, something just shifted under the surface. A signal subtle but undeniable. Stellar is on their radar. No, BlackRock didn't publish a headline screaming, "We love XLM." That's not how institutions telegraph moves. They telegraph through infrastructure alignment, through the shape of the rails being built. And Stellar just happens to be laying the exact rails that firms like BlackRock are preparing to run trillions over. Here's what most investors don't understand. BlackRock isn't interested in crypto for speculation. They're interested in tokenization, in digitizing financial instruments at scale: bonds, treasuries, money market funds, even ESG-linked debt. And all of that requires one thing: compliant, high-speed, programmable settlement infrastructure. Now ask yourself, how many blockchains actually fit that bill? Ethereum? It's powerful but expensive, congested, and still regulatory gray in key jurisdictions. Solana? Fast but too volatile for capital markets and still working on uptime. Ripple? Facing regulatory drag in the US, and its focus has largely been on cross-border liquidity. But Stellar? Low fees, real-time finality, ISO 20022 native, already embedded in cross-border pilots. And now with Soroban, it brings programmable finance into that same compliant framework. This isn't just speculation, it's infrastructure readiness. And if you're BlackRock, that's the only thing that matters. And here's the kicker: the tokenized treasury narrative that started with Ethereum-based protocols. It's already evolving. We're entering the phase where interoperable, regulator-friendly chains will carry the lion's share of tokenized assets. And Stellar's architecture isn't just ready, it's built for it. You don't need a press release to see the writing on the wall. When BlackRock-backed partners begin testing real-world tokenized funds, when ISO 20022 messaging layers are built into trade finance flows, and when custodians like Anchorage and Fireblocks are routing settlement activity through XLM, the message is loud and clear. Stellar's not a payments chain anymore. It's becoming the financial middleware layer for traditional finance's quiet shift into blockchain. And the best part? Retail hasn't even noticed yet how Stellar quietly became TradFi ready. To understand why BlackRock might even glance in Stellar's direction, you have to understand one key concept. TradFi doesn't move toward hype, it moves toward infrastructure stability. That's the game Stellar has been playing while most other chains were chasing headlines and retail mania. Let's break it down. First, Stellar was ISO 20022 ready before it was cool. While most chains were focused on NFTs or DeFi farms, Stellar was quietly aligning with the exact messaging standard banks and payment systems use globally. Swift, ISO 20022. SEPA, ISO 20022. Target 2, the EU's high-value settlement system, ISO 20022. This standard isn't optional. It's mandatory for any serious TradFi integration, and Stellar's protocol-level compliance with it makes it a natural plug-and-play option for banks, asset managers, and cross-border settlement systems. BlackRock doesn't need a coin with memes. It needs a protocol that speaks the same language as legacy systems. Second, Stellar's Soroban upgrade changes everything. Before Soroban, Stellar was seen as a high-speed payments layer, good for remittances, stablecoins, and simple asset issuance. But with Soroban, we now have fully programmable smart contracts, but with one massive difference. They're built for compliance from the start. Gas fees? Predictable. Execution? Deterministic. Risk of front-running MEV or validator collusion. Mitigated by Stellar's federated consensus and protocol architecture. This is not Ethereum 2.0. This is something closer to Ethereum meets Swift, with the bonus of real-time settlement, low fees, and regulatory clarity. Now let's talk tokenized assets, the part where BlackRock gets really interested. What is BlackRock's endgame in crypto? Not Bitcoin memes. It's tokenizing everything from treasuries to credit facilities to green bonds, and making them tradable, liquid, and programmable. But where can those assets live? On chains with proven security, embedded compliance tooling, interoperability with banking rails, stable cost and latency guarantees, and Stellar checks every single one of those boxes. That's why you're seeing quiet alignment from key players. Franklin Templeton already launched tokenized funds. Guess what infrastructure layer they're exploring for interoperability? Circle is scaling USDC on Stellar, not just for remittances but as a settlement token for institutions. Palago Labs, built on Stellar, is offering real-world trade finance lending tied to off-chain assets, fully KYC'd and auditable. And now rumblings from IMF and ECB reports reference Stellar-aligned technologies as testbeds for programmable liquidity frameworks. This isn't accidental. It's architectural. You're looking at a blockchain that isn't built for hype. It's built for asset managers who handle trillions and care about latency, compliance, and risk. In 2025, the question isn't, is Stellar cool enough to trend? It's how long until Wall Street starts running funds on Soroban, the tokenization boom, and why Stellar may be the hidden engine. Let's talk about the real crypto use case institutions are obsessing over right now. It's not meme coins. It's not NFTs. It's not even retail DeFi. It's tokenization of real-world assets. And this is where Stellar has quietly positioned itself as the dark horse no one's betting on. Yet, here's what you need to understand. BlackRock's CEO, Larry Fink, is openly calling tokenization the next evolution in markets. This isn't speculative. BlackRock already tokenized money market funds and treasuries on blockchain infrastructure through partnerships with firms like Securitize. So where does Stellar come in? Unlike Ethereum, which is bogged down with gas volatility and retail congestion, or Solana, which has experienced multiple outages and validator centralization, Stellar was built from day one with one thing in mind: asset issuance and movement at scale. And with Soroban now live, that foundation just went from fast and secure to programmable and institution-grade. Let's break that down. Asset issuance on Stellar is native. No need for custom token standards like ERC20. Stellar's built-in compliance tooling, like authorization-required flags and KYC-enforced logic, makes it ideal for issuing tokenized securities, stablecoins, and CBDCs. Smart contract logic on Soroban can now handle things like dividend payments, escrow functionality, lending agreements, and even programmable compliance. That's not theoretical, it's already being deployed by Palago Labs for trade finance. Stellar's throughput and fee structure make it practical for institutional scale usage. We're talking tens of thousands of transactions per second at a fraction of a cent. Predictable, auditable, and finalized in seconds. Here's why that matters. Let's say BlackRock wants to tokenize a $10 billion bond fund. They're not going to do it on a chain that can be front-run, jammed with Bored Apes, or spiked with $100 gas fees. They're going to look for a low-latency, regulator-friendly, globally interoperable protocol. That checklist? Stellar fits it like a glove. And we're already seeing signs of this setup. The ECB's sandbox report hinted at a non-Ethereum protocol aligned with ISO 20022 for programmable liquidity tests. IMF consultation papers describe tokenization pilots using consensus models that match Stellar's federated trust graph. USDC's full integration with Stellar's global MoneyGram ramps creates fiat-to-blockchain flow pathways that can directly support tokenized funds. Anchorage, Fireblocks, and Copper, all major custodians, have ramped up Stellar cold wallet support for institutional clients. Let's not forget one more thing. Stellar is already battle-tested in real-world regulatory settings. It's running in Latin America. It's active in Africa. It's embedded into currency corridors, licensed stablecoin programs, and even being considered in Europe's programmable money trials. So what's next? If even a fraction of BlackRock's future tokenized ETF infrastructure requires on-chain compliance, institutional-grade performance, regulator-friendly architecture, then Stellar doesn't need hype to pump. It just needs a quiet nod from the big players, and it becomes the infrastructure behind trillions in tokenized flows. The tokenization boom is coming fast, and Stellar might already be the hidden engine running beneath it. XLM's role in this institutional shift and what retail's missing. Let's zoom in. While retail investors chase short-term volatility, smart money is silently positioning around one key component, XLM, the native asset of the Stellar network. And this is where things get interesting. Most people think of XLM like gas for the Stellar blockchain. But that completely misses the bigger picture. XLM isn't just a utility token. In the emerging institutional context, it becomes a liquidity bridge, a collateral asset, and a settlement primitive baked into tokenized finance infrastructure. Let's unpack what that means. 1. Liquidity rails for tokenized assets. In a world where funds, securities, bonds, and even real estate are tokenized, they still need to move between entities, custodians, and jurisdictions. That's where XLM comes in. Stellar's path payment functionality allows any tokenized asset on the network to be swapped via XLM as an intermediary bridge. That's not hypothetical. It's already being used in fiat to USDC corridors via MoneyGram and other on/off ramps. Now imagine this at scale. A tokenized BlackRock bond fund needs to settle across platforms. The underlying smart contract uses XLM as the bridge to ensure compliance and liquidity across custody providers. It's like being the invisible grease inside a trillion-dollar engine. 2. XLM as institutional collateral. With Soroban now bringing smart contracts to Stellar, new use cases like on-chain repo markets, secured lending, and programmable margin requirements become possible. That opens the door for XLM to play the role ETH plays in DeFi, but in a fully regulated, TradFi-compliant environment. And guess what? Institutions love low volatility, liquid, predictable assets they can use as bridge capital or posted margin. Now combine that with Stellar's growing presence in interbank trials, its ISO 20022 alignment, custodial integration across Fireblocks, Anchorage, and Copper. Suddenly, XLM isn't just that fast crypto token. It's infrastructure-grade liquidity. 3. Native role in smart contract execution. With Soroban, XLM becomes the gas token for institutional-grade smart contracts, handling things like automated dividend distributions on tokenized stocks, settlement finality triggers between counterparties, on-chain triggers for regulated fund behavior. The logic is now programmable. The compliance rails are embedded, and XLM is what powers every execution. And here's the kicker. Soroban fees are predictable. No surprise spikes. No gas wars. Just deterministic, scalable computation. That matters a lot more than people realize. Because when a trillion-dollar fund automates payment logic, it needs stability, not volatility. 4. The retail blind spot. Retail isn't looking at this. They're waiting for a tweet, a TikTok mention, a spike on TradingView. Meanwhile, smart capital is watching. The IMF's language around cross-border programmable money. ECB pilots using Stellar-like architecture. Custodians onboarding XLM wallet integrations. Tokenization firms building on non-EVM rails. And they're not waiting for headlines. They're accumulating quietly because they understand what's coming. And if this shift plays out as projected, XLM becomes the functional equivalent of oil in a digital financial engine. Not flashy, not hyped, but absolutely essential. And by the time retail notices, that 12 cents price tag might be long gone. How Stellar quietly became TradFi's Trojan horse. Let's tie it all together. Because while everyone's watching Ethereum ETFs, meme coins, and L2 hype cycles, Stellar is quietly executing a different playbook. One that's not built for retail frenzy, but for institutional permanence. This isn't about viral growth. This is about embedding itself so deeply into the plumbing of traditional finance that the average investor won't even realize it's there, until it's too late to catch the move. Welcome to Stellar's Trojan horse strategy. 1. The ISO 20022 Trojan horse. Stellar isn't trying to compete with banks. It's integrating with their language. While most blockchains ignore compliance standards, Stellar speaks ISO 20022 natively, the messaging format now standard across SWIFT, ECB, BIS, and dozens of central banks. What does that mean? Stellar can be used directly in payment trials with central banks. Assets issued on Stellar can mirror the data fields regulators require. Smart contracts built on Soroban can communicate with legacy systems without middleware. This is the opposite of rebellion. It's adoption by stealth. 2. Soroban, programmable finance for institutions. While Ethereum brought DeFi to crypto, Soroban is bringing DeFi to banks, but without the chaos. Here's what Soroban is enabling: programmable settlement between banks using tokenized stablecoins, automated triggers for FX swaps, repo markets, and syndicated loans, on-chain identity and compliance baked into smart contract layers. That's the difference. Regulatory clarity at the protocol level. And that's why institutions aren't waiting for hype, they're already piloting. 3. Custodian backdoors. You've probably never seen an ad saying, "Buy XLM on Anchorage." And you won't, because Stellar's team isn't marketing to retail. They're walking into private meetings with custodians and prime brokers and getting XLM quietly integrated into Kappa's off-exchange settlement layer, Fireblock's MPC infrastructure, Anchorage's institutional staking dashboards. These integrations aren't for show. They're the setup phase before the wave of tokenized TradFi assets needs infrastructure to move, settle, and report in real time. And when those ETF-like wrappers hit the market, they're going to run on rails already built, and XLM is the toll token. 4. Silent expansion across key regions. You might have missed it, but in the last 18 months, Stellar has entered sandbox partnerships in Europe and Africa, onboard Palago Labs to power real trade finance lending, enabled USDC ramps in over 180 countries via MoneyGram, added Soroban support to regulated developer portals. This isn't just technical expansion, it's geopolitical positioning, because the next monetary order won't be built in Silicon Valley echo chambers. It'll be built where capital controls, regulatory frameworks, and FX friction need solving. And Stellar is already in those boardrooms. 5. Why this matters now. The BlackRock angle isn't just about attention. It's about blueprint validation. When BlackRock launched its Bitcoin ETF, it validated Bitcoin as a reserve asset. If BlackRock or any asset manager begins issuing tokenized portfolios, they'll need a compliant protocol, an execution layer with low volatility, infrastructure for regulated custody. And right now, Stellar fits that profile better than any other L1. This is why XLM is still under the radar. It's not because it lacks fundamentals, it's because the institutions who need it prefer silence while they build. Just like Swift wasn't on CNBC in the 90s. Just like TCP/IP wasn't hyped during the dot-com boom. Some infrastructure wins by being boring. But boring is exactly where trillions are headed. The smart money already knows. Do you? Let's cut the noise. If you're waiting for influencers to talk about XLM before you move, you've already missed the point. Stellar isn't trying to go viral. It's trying to become invisible infrastructure, like the internet protocols your bank already uses but never mentions. And that's exactly why the biggest players are watching it. BlackRock's move into tokenized assets isn't a trend. It's a permanent shift in how capital markets will function. And Stellar fits right into that future like it was designed for it from day one. So ask yourself, will you be early and quiet, or late and loud, buying XLM after institutions have front-run the entire float? Because by the time the headlines hit and the ETFs are live and XLM's price is parabolic, the real opportunity will be gone. Subscribe to Be Crypto Smart now, because this isn't about chasing coins. It's about tracking the infrastructure of the next financial system. And XLM is already in the foundation.